Coming up on Market to Market. Farm exports are predicted to rise next year, boosting America's agricultural trade surplus. The Justice Department halts antitrust investigations involving a major seed producer. And prospects for sweeping tax reforms rekindle conversations on the death tax. Those stories and market analysis with Don Roose next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, November 30 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Inventor and statesman Ben Franklin once wrote, "The only things certain in life are death and taxes." But that is definitely not the case in Washington these days, as America teeters on the edge of the fiscal cliff. Unless Congress and the President come to terms on some form of compromise, more than $100 million in across-the-board spending cuts and $500 billion in tax increases take effect New Year's Day. Last week, in a rare display of unity, congressional leaders from both sides of the aisle appeared confident of their ability to hammer out a deal. But the devil is in the details. Partisan bickering dominated the rhetoric this week, and by Friday, a compromise appeared to be nowhere in sight. And as policymakers search desperately for new sources of revenue, many Americans are considering the implications of significant changes in what is often referred to as the death tax. Paul Yeager explains.
I've got a starting bid on this property of $10,000. And now 10-1. $10,100 what is it? $10,100 what is it? $10,100 bill for it. 10-1.
Farmland sales are happening all over the heartland for a variety of reasons. In some cases, farmers are looking to expand their operations. Others are speculating on land values. And still others are trying to get ahead of looming tax increases that go into effect if policymakers fail to come to terms on hundreds of billions of dollars in tax increases caught up in the fiscal cliff negotiations in Washington. Jeffrey Obrecht, who bills himself as the dirt dealer, is close to $56 million in sales this year for his company, Farmers National.
Sold the farm. There's quite a bit that's coming on the market that is being driven by the tax incentives of whether they go up 5% plus a 3.8 Obamacare deal. No matter how you look at it today versus January 2nd. That farm January 2nd needs to be worth 8.8% more money than it is today to stay even with the board. That's kind of what's driving a lot of this.
Obrecht says sellers are willing to pay today's certain tax rate and avoid the what-if rate looming if America goes over the fiscal cliff. The federal estate tax, currently at 35%, could roll back to 55% if no action is taken. That rate has the attention of many in rural America. Currently, estates valued at up to $5.1 million are able to avoid all estate taxes. Those with higher values are taxed at the rate of 35%. But that all changes next year unless policymakers intervene. Effective January 1, the threshold drops to $1 million, and anything above that is taxed at a higher rate of 55%. Family-run manufacturing companies like Iowa-based Suckup Manufacturing are paying close attention to the issue.
It has big ramifications for us as a company.
Charles Suckup serves as president of the grain dryer and bin maker. His father, Eugene, started the company almost 50 years ago. And today, the Sheffield, Iowa plant employs more than 500 workers.
It just seems fundamentally unfair in one sense that these capital-intensive industries like manufacturing, farming, that you have to put a lot of money in order to be and have the capital equipment in order to have an operation, that they're put in jeopardy every 25 years as deaths occur in generations and get taxed over and over with it. The other thing beyond fairness is what is best for America. What do we want to have an incentive for? And I don't think making it harder and discouraging family businesses from continuing is something that's good for America in the manufacturing.
For Suckup Manufacturing and other family-run companies like it, that transfer of wealth, taxed at a higher rate, could dramatically reduce the impact on local economies.
But if you don't have the manufacturing and the wealth generation of creating something out of some very basic elements, you can't have much of a service economy.
Charles says an elimination of the estate tax would be ideal, but admits that isn't politically likely. Sukup says an estate tax exemption for family businesses would be a start. He says small businesses are the backbone of the economy, and taxing them multiple times could stifle companies like his.
You reach that point that the more you tax, the less you get of something generally, and you create less of an incentive for people to go out. A lot of people are feeling we're at that tipping point now where we need to incentivize people to take some risk, to be entrepreneurs, to start businesses, start jobs, and not count on somebody else doing it for them.
For Market to Market, I'm Paul Yeager.
Estate tax reform, of course, is just one piece of an intricate fiscal cliff puzzle. Treasury Secretary Timothy Geithner met privately with congressional leaders Thursday and proposed $1.6 trillion in higher taxes and $50 billion in new stimulus spending. The Obama administration's opening bid included plans for legislation next year aimed at saving $400 billion through reforms in Medicare and other programs. The administration also called for a permanent extension of the debt ceiling with no offsetting spending cuts. The proposal went over like a lead balloon with congressional Republicans who categorically rejected the offer. Further away from the fiscal cliff, other members of the Obama administration were dealing with more mundane activities. And in a move last Wednesday that may have slid under the radar during a holiday-shortened news week, the Justice Department halted its antitrust investigation of a major seed producer.
As we can be. I'm reminded of President Eisenhower's observation. I think this is a great quote. Farming looks mighty easy when your plow is a pencil and you're 1,000 miles away from the cornfield. Those words, I think, remain true today.
More than 30 months ago, the Obama Justice Department launched its first public examination of alleged antitrust practices in the U.S. agricultural sector. In a series of 5 workshops across the nation, officials studied everything from packer ownership of livestock to a perceived lack of competition between biotech giants. In a March 2010 workshop in Ankeny, Iowa, cabinet officials and farmers spent hours examining the nature of their relationships with seed companies. The discussion clearly demonstrated the Obama administration was examining allegations that agricultural giant Monsanto operated as a monopoly on products such as its trademark Roundup Ready soybeans.
Big is not bad, but with big comes an awful lot of responsibility.
Christine Varney, the Justice Department's chief antitrust officer at that time, entered the Obama administration pledging to tackle market concentration complaints and unwind what she called the extreme hesitancy of the Bush administration. After the March 2010 panel discussion, Varney acknowledged that the Justice Department was in the early stages of antitrust investigations, but declined to mention Monsanto or DuPont Pioneer, an underwriter of Market to Market. The Justice Department solicited information from both companies in the process of its investigation.
We do not bring a preconceived notion to the table. We do not have an agenda to pursue a result. We are not looking to restructure the economy or companies that participate in the economy. We are looking to enforce the law vigorously and fairly, wherever that takes us.
Attorney General Eric Holder took it a step further in describing a federal legal team ready to act quickly.
But you should not take from the fact that we're having these meetings the fact that we're simply sitting on our hands and then waiting for the 5th workshop before we decide what it is we're going to be doing. We are active right now.
But the bold press conferences and subsequent workshops across the country apparently led the Obama administration to a legal dead end. During Thanksgiving week, more than 2.5 years after launching its first workshop, the Justice Department quietly announced it was halting its antitrust investigation. Varney, who vigorously defended the Justice Department's examination of antitrust issues, left the administration in 2011, and Attorney General Eric Holder's future in a second Obama term is uncertain. Monsanto, which loses patent protection on its well-known Roundup-Ready soybeans in 2014, issued a public statement last week following the federal government's announcement saying, "We're pleased that the Justice Department has closed its inquiry and this issue is now behind us." But the legal wrangling is far from over between Monsanto and rival DuPont Pioneer. Earlier this year, a U.S. District Court in St. Louis awarded Monsanto a $1 billion judgment from DuPont, citing patent infringement. DuPont is appealing that verdict, and a separate legal case between the seed giants is also brewing. DuPont Pioneer's own lawsuit against Monsanto alleging antitrust violations could reach a jury in fall 2013.
With the make-or-break holiday shopping season in full swing, a report on consumer sentiment rose this month to its highest level in nearly 5 years. The Consumer Confidence Index rose more than half a point in November to 73.7. That's its best showing since February of 2008. But the gain was tempered a bit on Friday when the government reported that consumer spending fell 0.2% in October to its weakest showing since May. The National Association of Realtors reports pending home sales rose 5.2% in October, but orders for big-ticket durable goods to fill those homes were unchanged. And demand for core capital goods, an indicator of business investment, rose 1.7% in their best performance in 5 months. Businesses have been more cautious recently as fiscal cliff uncertainty and a deepening financial crisis in Europe threaten to push some countries into recession. That weighs heavily on U.S. exports. But shipments from one sector of the economy are booming, and the outlook for agricultural trade is bright.
A mixed outlook for oilseeds and feed exports, coupled with cheaper imports of tropical oil and processed fruits and vegetables, has USDA forecasting record numbers for 2013. Experts with the government agency are saying increased demand for oilseeds and steady request for horticultural products are all factors in setting record export values at $145 billion. The figures are a little more than 1% higher than third quarter projections and almost 7% over 2012's record. The new high water mark is projected despite a strengthening dollar and reductions in grain, feed, and livestock exports. USDA officials predict a weaker greenback in 2013, which would make for lower interest rates and easier financing opportunities in countries purchasing U.S. goods. Other reasons given for the increase were strong demand by China and limited South American competition. In its last report, USDA pegged imports at a record $117 billion, but this quarter estimates were lowered by nearly 2%. Slower U.S. economic growth was listed as the cause for a reduction in the forecast for U.S. agricultural imports in 2013 to $115 billion. That would be an 11% increase over 2012's $103.4 billion import tally. The reduced forecast for next year is largely due to lower prices for tropical oils, sugar, rubber, and processed fruits and vegetables. Contributing factors have been listed as lower domestic demand for food consumed at home due to U.S. buyers having thinner wallets. When considered with exports, the figures result in an agricultural trade surplus of $30 billion, down 7% from 2012. USDA predicts slower trade growth throughout the world in 2013. A continuing recession in much of Europe is expected to slow U.S. export prospects and weigh heavily on world growth into early next year. And while China is expected to increase exports, its new domestic policies may not be enough to encourage its citizens to borrow money. But there is still optimism that the expected end of the Eurozone recession, coupled with higher expected U.S. growth in 2013, will help move the world economy towards increased prosperity.
Next, the market-to-market report.
Grain futures contracts traded sideways this week as commodity traders pondered fiscal cliff uncertainty. For the week, December wheat moved fractionally lower, while the nearby corn contract moved 7 cents higher. Soybeans added to last week's rally as the January contract settled Friday with a gain of 30 cents. Nearby meal prices followed suit, improving nearly $15 per ton. In the softs, cotton traders rolled to the March contract, which posted a gain of $1.25 per hundredweight. In the dairy market, December Class 3 milk lost 45 cents, while the deferred contract moved a nickel lower. Over in livestock, December cattle lost $1.35, nearby feeders were off $1.75, and the December lean hog contract posted a weekly gain of $2.32. In the financials, the euro gained 167 basis points against the dollar, crude oil rose $1.53 per barrel, COMEX gold declined by $18 per ounce, and the Goldman Sachs Commodity Index rose 3 points to settle at 648.50. Here now to lend us his insight on these and other trends is one of our regular market analysts, Don Roose. Don, welcome back.
Thank you, Mike, and happy holidays.
And a happy holidays to you as well. Now, we've got some folks out there that maybe aren't so happy with the way things are going in Washington. We've talked about it a lot. Can you lend us your insight on where this fiscal cliff situation might be headed?
Well, it is a big deal. It's something that, all traders have an eye on, and we're watching very close. And I think when you look at it, what really happened this week, there was optimism when you think there's agreements, and then there's a risk-off trade when things look like they're kind of breaking down. So, that is an issue. And the other side of it is, you have to be optimistic that something positive happens, and then it's probably a risk-on green light trade.
And the risk-off trade you're seeing, is that affecting all markets pretty much across the board?
Yeah, I think the end of the week it did. I mean, we saw the meats come under pressure. We saw the grain market come under pressure. Gold, silver, a lot of selling at the end of the week. So I think it was pretty much across the board.
All right. Well, let's talk grains a little bit. Let's talk the wheat market. How have things been going there? I know we've had kind of back and forth different concerns in the wheat market. How do things stand now?
Well, I think in a lot of these markets, Mike, you have to ask yourself, long-term and short-term. Because long-term, what we're really very focused on a lot of these grain markets is the dry drought conditions. When you have 60% of the grain belt in a drought condition, you have wheat you're alluding to. It's 64% of South Dakota is in a poor to very poor state. What wheat has really done is just holding at the top end of the range. And we did have one negative thing on Friday. We had a poor technical close, and probably what that means is to start the week next week, we come under some pressure. We're a little bit overbought also, so I would look for a little bit of pressure to start the week.
All right, and do you see this continuing on through the month of December, January?
Well, we haven't made any headway. Actually, if you look on Kansas City March wheat, we've been, since July, we've been in a trading range. We've really been in a trading range for 2 months on the other grains. So I think it's one of these that you have to be very technically oriented. When you hit some technical weak signals and you break to the downside, but you get oversold, you find some support. And if the news stays equal, it's the dry weather and the world value that finds support, and we come back again. So that's really been the process that's been taking place on wheat.
So advice to producers out there, what numbers are you looking at as far as sell?
Well, I think when you look at new crop wheat, when you look at Kansas City wheat, when it gets close to this 940, 44 area, that's a double top area. But I think it's an area that, if you had moisture, of course, you would use that as a good opportunity. But if we get moisture, it's not going to be there. So I think what you have to do is use some of these trading tools and put some windows on these markets where you can lock in, a profit here, give yourself some upside room. But, it's all weather dependent from here forward.
You bet. And we're going to see that. Let's talk soybeans a little bit, also being affected by the weather. We saw the weather market take effect last week. Is that carrying forward this week, or what's driving the soybean rally we've been seeing?
Well, the soybeans, really what happened is they got deeply oversold. And so really it's just a technical bounce. We've had about a 60-cent rally. Then we're looking to see if we have any new news. If we don't have any new news, we start to sink a little bit again like we did on Friday. But, the soybean market, interesting, it topped out around September 4th, Labor Day, close to $18, and we had a $4 a bushel break. So, we were oversold. And what happened since that time frame is the U.S. yields grew, when the trade didn't think they could. We thought we had just razor-tight supplies, and now we have a bit of a cushion in the U.S., but it's all going to be up to South Dakota or South America when you look at the soybean complex, because last year, remember, December 15th, we started a weather problem in South America. So from December 15th to February 15th, that's going to be the big issue. Watch the weather in South America.
All right, so advice to producers out there, maybe with old crop beans they haven't sold? Thoughts?
Well, it's a merchandising challenge because there's a premium structure to the market. By that I mean there's an advantage to selling upfront versus the deferred. So there's better ways to own soybeans, particularly with the basis structure that's fairly decent and the inversion that we have in the market. So I would say market them. If you want to re-own it, you go to work and use some kind of risk management going the other way.
All right. Protect your upside and minimize that downside as we go forward.
Well, I think that's right. And, on new crop, there's some things we can do, too, because it's, put in a big window at $13. You can do a strategy where you protect at 13, give yourself a chance to go to 15, and, for not a whole lot of money. And I think, going forward, those are probably things to look at because it's all about weather, and we could go either way sharply.
All right. Let's talk corn. We saw a little bit of a rise again this week, 7 cents week over week. Where do you see the corn market headed?
Well, corn, again, it's much like these other markets. I think is, if you're talking short term or long term. Short term, of course, at the bottom end of the range on March corn, when we were down around 7.15, we were oversold. We were at some support zone. And what happened? End users came in and bought corn down at that area. Exports picked up a bit, and also end users. And then as the market moved to the top of the range, up around this 67.5 area, exports just died. And the end users put their hands in their pockets. The market stalled out, and we've had a pullback now. And where we're really at, the wheat market closed very poor on Friday, the end of the week, in technically soft position. And corn is right there too. 748, 750 needs to hold early in the week. If it doesn't, we're probably going to start a little bit of a move to the downside until you get oversold. But I guess what we're really saying, Mike, is we really haven't gone anywhere. It's been 2 months in a 50-cent trading range. And part of the reason we're doing that is because the information really hasn't changed. And that's what we're looking for.
As we bounce back and forth in this trading range, that 50 cents, what is that doing for the end user? I mean, how is that impacting our future demand as we look to next year?
Well, what the end user is really doing is he's really more hand to mouth, really not out real far with his coverage. At least that's what we think. And so he's a selective buyer. When you move to the top of the ranges, he also stalls out on his buying. But when you get at the bottom of the range, he gets pretty aggressive. But the end user, actually, what he's looking forward to is hopefully we have some better crops this next year. We improve the moisture, and going forward, you can buy your inputs at a lot lower levels.
Do you have any advice for producers as far as marketing 13 crop at all?
Yeah, that's a good question, because I tell you where we're at with corn, it's an important situation because you're at a level where obviously when you have 60% of the corn belt in a dry drought status, that if we don't get moisture, the market has a chance to move up, and we know it can go to at least $8.50 now because we did last year. At the other side of it, we have a chance to drop under $5 a bushel, I think, pretty easily if we end up with some trend line yields or more, if we're going to get this 97 million acres. So what I would say, a window contract, you can buy 640 December corn puts, sell the 740 calls, and sell puts below them $1. Give yourself a $2 range, up or down, and spend about 10-15 cents.
All right. Now, as we're talking end users, let's look at livestock a little bit. Where do you see the feeder cattle market headed?
Well, I think when you look at the feeder cattle, what you really have is a corn market trade, because the feeder cattle put in a top, in the low 160s in the spring, May, June. That was at the same time the corn market was at the lower end. Well, corn went up and feeders dropped about $20. So what you have is, a feeder cattle supply that is limited. Feedlots are going to buy feeders on breaks here. They're value buyers. But if the corn market goes back up or goes down, the feeder cattle will move back up again.
All right. As we look over into live cattle, what we've seen close to record high retail beef prices. Do you see that keep continuing? Where do you see the live cattle trade headed?
Well, and you hit the nail on the head. With this fiscal cliff that we've talked about, back to that again, it is an issue. And when the choice beef gets into this 195 to 197 area, just hard to move beef, And so consequently, the consumer switches over to cheaper products, pork, which is one of the reasons that pork is gaining on beef, and to poultry. The packers losing about $70 a head. And so we get these pullback in the market. And on Friday, we traded cattle sharply lower, down $3 a hundredweight. Packer is losing money, not willing to pay up. Feedlots were forced to push cattle out the door, and I think more of that's going to continue. Although long term, the cattle market is very positive, but we have a tough time getting over 136 on cattle.
When you say long term, the cattle market's very positive. How long term are you thinking? Are we going to have to wait for the economy to turn around? What's going to push us over that
Well, there's
hump?
two sides to the story, and one is the supply, and we think the supply is going to be positive. You probably have 2 years of positive supply before you can rebuild a herd. It just takes that time. On the other side, there's the demand side. And the consumer, what are we going to do? Because we're trading cash cattle, we'll say 125, 128, and we can't move beef at this level. So the futures market has a structural premium of up to the mid 130s built into next year. What's going to happen? So I think you have to, when you look at it we're positive cattle, no doubt about it, but it's up to the demand.
All right. Let's talk hogs a little bit. We did see a nice little rally in hogs this week. Was that due to the consumers switching their demand from beef to hog? What's driving that this week?
Well, I think it is. We were talking about the Packers losing about $70 a head on cattle. He's still making money on hogs, about $5-6 a head. So what we think is really happening is the Packers killing hogs now at a profitable level, putting them in cold storage. The domestic demand is a little bit better because of the high-priced beef. So that combination has allowed the upfront hogs to move higher. Actually, December hogs moved to the highest level that they've been since early March. Now, in the back months, if you look at it, we haven't gone anywhere for 2 months, just like the corn market. From April on, the hog market's just been stuck in the same range as corn.
And you see that continuing for a little while?
Well, I think it's a corn trade is what it is. The feeder cattle are a grain trade. The hogs are a grain trade. So I think you have to keep a close eye on that. But it's all up to the weather and the grain. I think we stay in this trading range. We stay in the trading range in the hogs in the back months. But when the weather pattern starts to change one way or the other, that's going to be our move.
Great. Thank you so much, Don. Appreciate having you here. That wraps up this edition of Market to Market. But if you'd like more information from Don on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us next week when we'll learn how tougher immigration policy is creating a shortage of farm workers. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.